How to diversify with whole life insurance. Have you ever heard that term, or the term diversification you've likely heard of, but have you ever heard of diversifying your portfolio with whole life insurance? Well, I'm specifically talking about the cash value here, and when it comes to cash value life insurance, if it is set up properly, a life insurance policy can be considered and is a fixed savings asset. It's an asset class. The thing is, making sure a policy is set up properly is critical. It adds an extra step. But when it comes to diversifying a portfolio, typically we see money in what areas? The stock market. We can do extremely well in the stock market. This is why it's number one on the list. People have done very well. If you look at just 2019, the full span of 2019, beginning of January through the end of December, the S&P 500 produced almost 30%, a little bit over that actually. Killer year for the S&P 500. But then at the same time, we have a degree of risk where we can lose money. 2008 occurs. Perhaps we look at the month of March in 2020, where everything just tanks for a period of time. You do have a degree of risk with the market. Now, I'm not saying that's a reason why not to invest in the stock market. My firm belief is if I have money in the market, or if you have money in the market, stick to that strategy. Same thing with real estate. Whether you are into flips or cash flow producing real estate, rental properties, whatever it might be, whatever your strategy is, stick to it. Where people get themselves into trouble and end up losing money is when they start out with a strategy, then they start to doubt it and they pull out, and it's almost always at the wrong time. Sometimes things are timed right if we're looking at the market, but stick to the strategy. Look at the stock market. Very risky, considered by many to be very risky, but look at an individual like Warren Buffett. Everyone knows who he is. Long-term investing, stay the course. Takes a risky area to position your money and stays the course. Stick the course with whatever you're doing and look at other areas when you're diversifying and how you can enhance your overall portfolio. That's the purpose of this video, and really to provide more education on whole life insurance and how to maximize the cash value. So we've got the stock market. There's an area that has a degree of risk, but also a degree of reward at the end of the day. Real estate can do very well with real estate, and you have a degree of control as well. Business, if you own a business, I own a business, for example, and I'm a firm believer of reinvesting as much money as possible. Instead of taking personal profits, put them back into the company. Hire more people, duplicate yourself, get the message out there more. How do you continue to move fast, duplicating models like Amazon, Apple, companies that have grown very, very quickly, that have competitors that do the exact same thing as them, but why do some companies do so much better? Is it because they're just smarter? They hire smarter people? No, they move faster. How do they continue to spend money on their company instead of saving it for themselves? That's one of many reasons. There's more to it than that. And then the bank account. You know, this has become more popular really since 2008 occurred. Market tanked. A lot of people had money invested in the stock market. Maybe it's even qualified accounts, and they move it into cash instead of having money in mutual funds and stocks within a qualified account. You know, I remember when I first connected with our good friend Dr. Ace. And in our first or second phone call, it was our second actually, he lets me know I'm kind of a cash cow. He would stockpile a lot of cash because there were certain areas he was comfortable positioning his money and certain areas he was not comfortable positioning his money. He's a fan of the S&P 500 for long-term investing, but there are times when he thinks it's overvalued. He's not a fan of it, and he will be sure to let you know that as well. He's done very well for himself. But as far as looking for a safe area to position money, here's an individual that does very well, and he says, hey, right now I'm just stockpiling money in cash because I'm debt-free. I want to put the money somewhere safe, but I don't see anywhere else safe to put it that provides me the liquidity and a decent return. If I want a decent return, what's going to happen if I go outside of my bank account? I got to take on some degree of risk. That was his thought. So, as an alternative in diversifying his portfolio, we looked at whole life insurance. Now, the key here is the policy must must be designed for maximum cash value. If it's not, we can take a whole life insurance product and see the worst thing on the planet in terms of somewhere to position our funds for cash value benefits. You know, often people look at a whole life insurance policy or they see a company with a dividend rate of 6% and they're told, hey, you're going to earn 6% on your money, or they think that. Not the case at all. Life insurance has several moving parts. It depends where our money goes. Let's give a quick overview here. One, if I see a company with a dividend rate of 6% and a guaranteed rate of 4%, that is a gross rate that is credited after the insurance expenses, after the company's mortality charges, everything that's involved in the actual life insurance product. There's still life insurance, a death benefit there. Why I state that, or why I state it in that manner, is because on paper, a 6%, 5%, whatever the dividend rate is, even the 4% guaranteed rate, looks very attractive. However, that is not what we are earning. That's why we have this 3 to 5% here. That is a net after-tax internal rate of return, what we can expect to earn on a policy if it is set up properly. So, what does that mean, set up properly? Well, we will talk about this very frequently. Let's provide a quick overview here. Our policy design. So if you are in a position where you want to put any amount of money into a policy, whether it's for a long period of time, or maybe you have a lump sum and you don't want to be committed to payments for a long period of time. How do I, again, diversify my portfolio, use whole life insurance as an asset class, and actually see that 3 to 5% with guarantees built in, no risk of ever losing money? How do I set it up properly? This piece that I'm going to touch on next is the key as far as a knowledge standpoint is concerned. And when I spoke with Dr. Ace, who said, hey, I'm a cash cow, Steve, because I just want to put my money somewhere safe and have access to it in the event I want it for anything, this was appealing to him. He was pitched on whole life insurance in the past, was okay, but did not pull the trigger for himself. He did pull the trigger for himself once he saw exactly what I'm about to show you, which is this. He wanted to see money in cash value right off the bat, and when he pays any amount of money in, or if you have a life insurance policy, here's the key on this. You, the policy holder, can actually choose where your money goes. If I'm going to pay $1 in, for instance, or for example, I can choose what percentage of that dollar goes towards the insurance premium and what percentage of that dollar goes to what is called this PUA, stands for Paid Up Additions Rider. Here's the English translation. Premium, initial insurance expense. PUA rider, cash dump in. Let's see how these areas work very quickly. If you were to pay $1,000 per year into the premium and $1,000 per year into the PUA component, what happens? How does your $1,000 actually show up in cash value? That's the question. Well, the $1,000 that you pay towards the premium, the insurance expense component, nothing shows up in cash value for at least the first year, but often the first and second years with most traditional policies. Now, as time passes, once you hit the third year, you see your payment come back and you start to earn interest on it. You've got access to money, but in the early years, I've got nothing to show for it. The reason why is the insurance company is going to overcharge me for the death benefit or cost of insurance up front. That is really where an insurance company makes their money with these products. Their initial money. They make money over the life of the product. However, in the first and second year with a whole life insurance product, they overcharge me for the premium. You'll see where I'm going with this versus the same $1,000 allocated towards this PUA component. Pay $1,000 in. You'll see just about $1,000 show up in cash value. That's money I can access and begins to earn the guaranteed rate plus any dividends immediately. Now the term PUA stands for paid up additional or additions because it purchases us paid up additional life insurance. Where the term paid up comes from is this guy right here, this PUA component is optional, or let's use the term flexible. Meaning, I can pay that $1,000, I can pay $10,000 there, I can pay nothing at all. Very flexible where I can decide to add money or not to add money. So often what we'll do in making these products flexible, because again, if I'm going to diversify and use it as a flexible savings asset, I don't want to be locked in or committed to a bill and have the thing feel like a burden. That is not appealing to many. So if I make it flexible here, I can dump money into PUAs at discretion. So we do have to have something go towards the premium. We often get the question or statement first, I don't care about the death benefit. How do I pay nothing into the premium piece and put it all towards the cash value? So we can't put 0% into the premium. Depends on the insurance carrier. You'll often see with a lot of the top companies, you can get it down to 10%. Some smaller companies, you can go lower. So technical detail here that we just covered. Sometimes I go into too much detail. Here's the point. Let's get back on point and look at the simple version here. I want to diversify my portfolio. I've got money in the stock market, real estate, my business, but then my bank account keeps piling up and I'm earning 0% or I'm earning, this is aggressive, 1.5%, which will likely continue to go down. Maybe it's an initial entry rate or something like that. Let's call it 0 to 1%. Not that attractive in the bank account, and it's taxable, whatever the return is. But it's safe and it's liquid. How do I maintain the liquidity and the safety? A cash value life insurance policy does just that. Safe area to position money. Liquid area to position money. I can get to it very quickly within a few business days once I've got money in the policy. So let's look at an example here. If you've ever seen whole life insurance, this will look different than what you have likely seen in the past. So here we go. We've got two examples here for 2021. We see a conservative dividend rate of 5.65%. Why I state the term conservative, if you were to look at the top companies, you'll see Mass Mutual at 6%, New York Life at 5.8%, Guardian at 5.65%, Northwestern at 5%. Then you'll see a lot of other carriers like Penn Mutual at 5.75. You've got Lafayette at 5.2. Why I'm throwing that out there is this 5.65 is kind of in the middle of the road, a bit conservative, not super aggressive, not illustrating the best possible rate. $50,000 for 6 years, $300,000 total into the policy. What's highlighted in yellow here, well, let me rephrase. Let's look at just year one. He pays in $50,000 and he's got just about $45,000, almost 90% of what he pays into the policy available immediately. That's what he has access to. This is a cash-rich policy, traditional life insurance, non-MEC, so I don't have to deal with taxes or anything like that. And then what is highlighted in yellow represents his break-even point, when he has more money in cash value relative to what he had paid in. He does have a death benefit as well. If he were to die, the death benefit is paid out 100% income tax-free. Now, we've got two IRRs here. IRR stands for internal rate of return. What am I actually earning on the policy after the company's insurance expenses, mortality charges, because they tell me a 5.65% dividend rate, that's not what I'm earning once I peel those insurance expenses out. So here we go. First year. The worst part about any life insurance policy is the first year. I've got a negative 10% hit on the annual and the average return here. The annual return displays what I am earning year to year. An example or illustration would be, hey, I earned 18% last year in the market on my stocks or mutual funds. The average return would be, hey, over the past 30 years, I've earned 8% in the stock market, or here's what the market averaged out over the past 30 years. So annual isolates each individual year on the internal rate of return, whereas the average IRR will factor in the early years and the negative returns as well. So why that's important is if I look at year 2, I pay in $50,000, the cash value grows by more than $50,000. That's why that particular year I see a 0.48% return. Tax-free, so it does boost that a little bit, but it's still not that much. However, that does not bring my average positive. Over 2 years, I've paid in a total of $100,000. I have just over $95,000. So my average internal rate of return is just over negative 3%. So that's got to be disclosed. This will really help me refine my decision-making process to say, hey, in the early years, which are the worst part about these products, if that hit makes me uncomfortable, then I might not be a fit. But better to see that and have it disclosed up front instead of attempting to play some kind of game with you and say, hey, here's the dividend rate, you're going to have all this money, just focus on the long term. Ever hear that one? No. Here's how it works. Here's what I've got up front, and as time passes, here's the annual, what I'm earning year over year. So we mentioned safe, liquid area to position money, somewhere between that 3 to 5% range, based off of a conservative dividend rate, a little over 4%. Historically, we've got policies and we have information on this in our membership program and agent training portal. We've seen policies produce stronger or greater than 3 to 5%. We're in a very low dividend rate environment right now. I do not see that going up in the near future, so we're pegging it a bit more conservative here. Just from a setting expectation standpoint. A little over 4% on the annual. If we look at the average, you're going to top out right around 3.5%. It gets up to 3.75 as the years pass, based off of the conservative dividend approach. Right, if we keep going, you'll see it hover around that level. So, again, safe, liquid, tax-free area to position money. No risk associated with this whatsoever. If I'm a cash cow and I have too much money just sitting in the bank or I'm accumulating it quickly, here's a nice area to position it. The thing is, if I am able to and comfortable paying in for a number of years, so we stopped at age 40 for 6 years, we can fund it for 2 or 3 years or longer. Point being, 1 year typically does not do it. So if I have a large lump sum, I might want to break that up over a couple years, but a one-time payment is typically unattractive with a policy. Let's look at a more aggressive dividend rate. And here we go. Same thing in the initial years, but as time passes, you see the annualized internal rate of return get over 5.1%. And we see the average internal rate of return top out just about 4.7%, which is solid. So again, we mentioned that 3 to 5% range. Historically, the strongest policy I've ever seen was a policy that was issued in 1975, so that's going a ways back, and it was just about 7.1%. That lived through some nice dividend rates too, 12 and 13%. Not expecting to see that again. The 4 to 6 range is what we used to state in the low interest rate environment right now. Again, just setting expectations more properly here, utilizing cash value life insurance as an asset class. Good product to be aware of or utilize once I know how to utilize it, or have someone that sets it up properly for you. That's what our office does. We'd love to work with you in that respect, or if you have any questions, feel free to reach out to us anytime. As always, I hope that this helps, and we will talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.